On 3rd December 2025, Ethereum launched the Fusaka Upgrade, and these are a set of technical changes to the network that hopes to make Ethereum an even more reliable and scalable platform. But in the context of BMNR, we have to understand how these technical changes affect the price of Ethereum and potentially changes the valuation for BMNR in the months and years ahead. But as always, potential is a dangerous word, so let's dive in. The Fusaka Upgrade actually consists of two separate components called Fulu and Osaka. These are two separate technical changes to the Ethereum network that combines together to form the Fusaka Upgrade. So Fulu is the technical upgrade to the consensus layer of Ethereum, and Osaka represents the technical upgrade to the execution layer of Ethereum. Now, I've previously explained what the consensus layer does and what the execution layer does and how they work together. So I will link that video up above for you if this is the first time you're hearing about these terms. But without getting into too much of the technical details right now, the main reason why these two upgrades work in tandem, it's because Osaka increases the bandwidth of the Ethereum network to handle data, but this by itself isn't useful without making sure that the validators that are securing the network can similarly handle the new massive data load, and that is the job of Fulu. It makes data verification on the Ethereum network a lot more efficient. And so this Fusaka upgrade is actually part of a much longer roadmap to make Ethereum a much more reliable and scalable platform for developers. And in one of my previous videos, I've actually spoken about the Denken upgrade. This happened, I believe, sometime in 2024. And it was an upgrade that massively improved Ethereum scalability. And they did this by introducing these things called blobs. So what exactly changed when they did the Denken upgrade, and what are blobs? You see, originally, a lot of these layer 2 applications that are being built on top of Ethereum had to post their data directly on the Ethereum network using something called call data. Now, I know some of these terms are very technical, but I'll use a simple analogy later to make all of this relatable to us. So when that happens, when they post all of this call data to the main Ethereum network, every single byte of this data is stored permanently on the Ethereum network. So if you think about the blockchain, like I said previously, as a digital ledger or a huge Excel spreadsheet, every new transaction will then be permanently increasing the size of that spreadsheet, adding a new row of data. And as the spreadsheet gets bigger, it gets more expensive to run because it requires more storage, it requires more hardware for the validators, and it results in slower syncing as well as higher gas fees, making it more expensive to operate on Ethereum, which means fewer people will be able to run these validator nodes, and as a result, there's actually going to be less decentralization, which is basically the primary purpose of Ethereum. Because every time you process a transaction on an Ethereum L1, you are literally asking every single validator in the world to preserve that data forever. But here's the thing, you see, for many of these applications, especially things like games and high volume consumer apps, you don't need every single piece of data to be preserved forever. So let me give you a very simple analogy over here. Imagine you are playing a game like Angry Birds on your iPhone. Millions of people around the world also play Angry Birds. Now, storing and processing all of that data on the Ethereum L1 is like asking Apple to store all of your Angry Birds data along with the millions of other people's Angry Birds data in the iOS itself. So every time Apple updates the iOS, they will need to migrate your old Angry Birds progress. They will need to migrate the data of every bird you flung, every block you knocked down, and every level you played, all the way until your current level into the core operating system. So over time, naturally, iOS would become bloated and clunky because all of this Angry Birds data is going to be stored permanently within the iOS software itself. So that obviously doesn't make sense. So the solution at the end of the day is not for Apple to store your Angry Birds data within the iOS operating system. The solution is for Angry Birds to store its own data while still running on iOS and giving you the same UI and UX that you enjoy using the Apple iPhone. And that is exactly what Denken Upgrade did for Ethereum. And so with the Denken Upgrade, what actually changed is the introduction of blobs. And blobs basically allowed the layer 2 applications on Ethereum to post their data temporarily onto the Ethereum L1 without taking up too much space. So the validators are able to store the blob data for around 2 weeks. And during these 2 weeks where they are storing the blob data, the data is being broadcasted to all validators. Anyone can download it and reconstruct the transactions. But the key difference over here is that after these 2 weeks, Ethereum no longer stores the raw data permanently. It only stores the result of that data permanently. So what do I mean by this? If I bring you back to the Angry Birds example with the iOS, initially we said that, every time an L2 performs certain action or carry out certain transactions, this data is being permanently stored on the Ethereum L1. So what this means is that Apple stores every single action you take within the Angry Birds app forever. However, with the introduction of blobs, what actually happens is that for perhaps the first 2 weeks, Apple stores every single data, every single action that you perform on Angry Birds within the iOS system. However, after 2 weeks, all of the data regarding the actions that you perform in the Angry Bird app itself has disappeared. What remains is the level that you are at, the progress that you have made, and that is going to be able to be provably correct forever. And so what that means is that years later, Ethereum can still prove that at one point in time, Elijah has reached level 100 on Angry Birds. However, it will not preserve the data around every single step I have taken in the game in order for me to reach that result, but only preserving the result itself in a way that can be verified. And so this leads to much less bloat on the Ethereum L1, and because the data is not being stored on the L1, they don't have to pay any execution gas fee, and what the L2 applications end up paying is this fee called the data availability fee. This is a much cheaper fee because you're not paying for storage, just a verifiable end state or result. And so once blobs actually went live, we started to see the posting cost for L2 fall dramatically by anywhere between 10 to 100x. And as a result, the activity on the Ethereum network started to expand, and daily active users on all of these L2 applications started to skyrocket. And so as a result, even though the fees that are being paid by all these L2 applications was actually reduced, the burn rate of Ethereum actually stayed strong because the total volume on the Ethereum network went parabolic. And so what Denken proved is something very important for the entire Ethereum network, and that is Ethereum does not require high gas fees in order for them to burn ETH at a healthy rate. It just needs activity on its platform, and this is very much in line with the entire thesis surrounding BMNR. And so the problem that Denken solved was around scalability, and once Ethereum became more scalable, more users started coming on chain, and because of that, new problems started to emerge around user experience, and that is exactly what the second upgrade, Petra, set out to fix. Now, this was launched on 7th of May 2025. Now, broadly speaking, before this upgrade, using Ethereum kind of felt like using the internet back in the 1990s. Everything was slightly clunky. Every action needed a signature, and every login required your seed phrase. Of course, if you lost your password, you lost your seed phrase, then GG, you're screwed, right? You lose access to that account. So it's a little bit like payments before the invention of Apple Pay, or if you're in Singapore, things like PayNow and all of those one-click payments. And on top of that, I think the fact that the layer 2 applications could not help you recover, oh my goodness, my English, recover your account if you lost your login details actually posed a huge problems to users as well. And so one of the biggest changes introduced in the Petra upgrade was an instant account abstraction. So this means that there was no longer need for seed phrases, and of course the L2 applications can pay the gas fees on your behalf, and you get all these one-click logins as well as biometric approvals, which is basically the same technology that is being used by Face ID. And so this means that all of these applications can actually help the users to recover their accounts if they actually get locked out, and it became a lot more seamless to use the Ethereum network. So this also gave us improved signature flows, which is just a fancy way of saying verification and authentication, and it made the whole process much lower friction with fewer pop-ups and fewer of those "are you sure" kind of messages. But Petra didn't just help the users, it also made it easier for validators to secure the Ethereum network, because validators can now cycle in and out more efficiently with fewer delays and fewer risk of correlated failures. And all of this really sets the stage for the next upgrade, which is what we are talking about, Fusaka, on the 3rd of December 2025. And so we know now that Denken helped to solve the problem around scalability, and then Petra helped to solve the problem around user experience. And what Fusaka aims to do is to help solve the problem around unit economics. You see, earlier on I mentioned that Fusaka is actually a combination of two separate technical upgrades rolled into one, and the end result of this upgrade is actually simple. They hope to see burn rate go up and issuance actually start to come down, and they also want to make it safer for a lot of these validators to stake their Ethereum. And at the end of the day, the end result is that Ethereum will become more institution ready, and all of this forms the core thesis around BMNR. So why does all of this matter? Because earlier on I told you that Denken introduced this thing called blobs, and what happened is that some of these blobs caused certain issues to arise. So to keep things simple without getting too technical, certain data types were actually too cheap and certain operations actually cost less than they should, right? And there were also loopholes that users can use to bypass the gas fees, and blobs could be spammed on the L1, which actually sometimes caused the network to be congested. And so all of these things actually reduced how much Ethereum was being burnt, and it made the entire Ethereum network much less efficient. And so this is why in my previous videos I have pointed out that the net Ethereum issuance has actually ticked up after some of these upgrades, and that is something that Fusaka is designed to fix. You see, the first technical fix, which is Osaka, closes a lot of these loopholes that we have mentioned. It ensures that users pay their fair share for the block space that they consume, and it reduces the cheap spam on the Ethereum L1. And so naturally, as the block space is being priced honestly, priced more fairly, the amount of ETH being burned actually goes up. And the second technical upgrade over here is Fulu. This actually strengthens the consensus layer, which directly impacts the validators. And the biggest improvement over here is the PeerDAS, short form for Peer Data Availability Sampling. This is a term that many of us would have seen on X recently, and I think many of us might have been confused around this term. At least I was confused around this term, so I had to do a little bit of digging to try and understand this term. And so let me try and explain this to you using a simple analogy. Now imagine Ethereum's validators are like school teachers who have to check the homework of many students. Before the Denken upgrade, the power was small, right? Maybe they have to check 10 worksheets every 12 seconds, and that was relatively easy for the school teachers to handle. However, after the Denken upgrade, with the introduction of blobs, because the activity on the layer 2 started to increase, they started to post massive amount of data through all of these blobs. And so suddenly this power of homework, instead of having to check 10 homework every 12 seconds, they now have to check 10,000 worksheets every 12 seconds. And validators all around the world must confirm that this data was broadcast, available, not missing, and not corrupted. But here's where the problem started to show up. You see, not every validator out there has high-end software or access to enterprise-grade internet. Many of the validators are running their own home setups on older nodes and perhaps even live in places with weaker internet connectivity. And so as the data load exploded on the Ethereum network, some of these validators really simply couldn't keep up, and they began missing attestations, which leads to penalties and sometimes even slashing. And so this really wasn't an issue about validators being malicious or lazy. It was really an issue around bandwidth as well as hardware capacity. The Ethereum network just evolved and expanded a lot faster than how some of these validators could handle. And the problem over here is that if this was allowed to continue, many of these smaller validators would struggle and eventually drop out of the system, and that would lead to a consolidation of power within some of these bigger institutions with powerful hardware that are able to keep up with the data load. And that actually leads to centralization, which is the complete opposite of what Ethereum is trying to achieve. And this is also not something that institutions want, because they want to build on a credible yet neutral and decentralized foundation. So how does the PeerDAS actually fix this? Now, going back to our worksheet example, instead of requiring every validator to check all 10,000 worksheets, what the PeerDAS lets validators do is to check small random samples of data, maybe let's say 100 random pages. But here is the crucial part. Every validator checks a different random set. They don't check all the same 100 pages. And if any validator finds a missing piece or a corrupted piece, the entire block of data is rejected. And so because all of these validators are sampling different pieces, the chance that every single validator misses a missing chunk or a corrupted chunk is effectively zero. And that is why the PeerDAS drastically reduces the workload per validator, and no one needs the full stack of data anymore. And at the same time, they're still able to guarantee that all the data that is being processed is actually still available to the network and is actually following the rules of the Ethereum network. And this is why PeerDAS drastically reduces the workload per validator, because instead of having to check through the entirety of the 10,000 pieces of data, you now just have to check through perhaps 100 pieces of data, which reduces the stress on a lot of these smaller validators, because no one needs the full stack of data anymore, and all the while still being able to guarantee the validity of the data on the Ethereum network. So just a quick note over here, because I know some of you will ask, if validators only check pieces, isn't there a loophole that certain things can actually slip through the cracks? And the answer over here is no, because PeerDAS uses cryptographic sampling, where the words almost certainly or effectively zero means that this is actually mathematically impossible with all the computers in the universe. If this type of sampling could be bypassed, the security behind the Apple devices and banks and every single modern crypto system would fail. So it is not a loophole, this is basically the security model. Tying all of this together is understanding the impact that all of this is going to have on the price of Ethereum as well as BMNR's valuation on the basis of shareholder yield. Now, I've spoken about this previously, how to use shareholder yield as a valuation method in a separate video. So if you have completely no idea what I'm talking about, I'm going to leave the link to that video down below for you. But by and large, the high level understanding is that because Ethereum is a cryptocurrency, doesn't really generate any real profits the same way a business does. The easiest way for us to actually understand its valuation is by using the shareholder yield. And even then, because Ethereum is a cryptocurrency, there are certain aspects of it that are different from a business and a stock. The valuation method is still slightly lacking. So please use the numbers that you're seeing here really as an estimate and don't take them as if they are written in stone. But with that said, there are some assumptions that we have to understand to basically take us through this valuation. Now, fundamentally, you have to understand that NVIDIA generates shareholder yield by using their profits to do share buybacks as well as issue dividends. And the argument that Tom Lee has made is that Ethereum in some ways actually mimic this. Now, with the increased levels of activities on the Ethereum network, this leads to an increased amount of gas fees, which leads to an increase in the burn rate. Now, with an increase in burn rate, it means more ETH is being destroyed every year. And as a result, this lowers the circulating supply of ETH. This is similar to share buybacks. Now, at the same time, we are going to see an increase in issuance given to validators as more validators come on board to secure the network, and this is similar to dividends being paid out. So I just want you right now to compare the screenshot over here from one of my previous BMNR videos and notice that the annualized ETH burn rate across the last 30 days during that video was around 66,000. This was taken around 1 to 2 months ago, with the issuance coming in around 971,000. But on 3rd December, when I took this second screenshot over here, you can see that the annualized rate of Ethereum being burned now stands at 18 million. Now, this is not to say that 18 million ETH has been burned this year, but based on the level of activity on Ethereum across the last 30 days, we are on track to burn 18 million ETH if we keep up the activity levels across the next 12 months. This is actually 300 times more activity than what we were seeing on the Ethereum network 1 to 2 months ago. Now, of course, I know this is definitely not going to last because the level of activity at times really fluctuates on the network. But importantly, this proves that with more activity coming on chain, Ethereum can really be deflationary, and you can see that issuance actually remains more or less stable at around 972,000. So combining this with the Fusaka upgrade, which hopes to make Ethereum even more efficient, right now the current supply of ETH is growing at around 0.77% every single year. I'm expecting to see this number shrink further or even turn negative. And so all of this really tells me that parts of this model really need some changing. And so let's take a look at the model. Now, initially, I was assuming a circulating supply of ETH at around 120.5 million ETH. I don't see any reasons to change this. I think with the increase of activity that we are seeing on the Ethereum network, as well as the Fusaka upgrade, this really supports the argument that this 120.5 million ETH really is a good estimate for this valuation. Now, in terms of the amount of ETH being paid to validators, this has come in at around 972,000. Now, the next thing I want to point out to you is this green box over here, the amount of Ethereum being burned. I've chosen to use 900,000 ETH tokens being burnt every single year as an estimate. The reason for this is that because this is 20 times lower than the current levels of 18 million ETH being burnt every single year and 15 times more than the 66,000 level that we were seeing 1 to 2 months ago. So basically more or less a midpoint between the two numbers. Hi, this is post-production Elijah speaking, and I'm just jumping in to let you know that I'm well aware that the numbers that we are using for these calculations, because they were taken on or around 3rd of December, they are not necessarily representative of what is going to happen in the Ethereum ecosystem after the Fusaka upgrade. And so what I'm actually doing is to wait over the next couple of weeks and observe where the levels of issuance and basically their burn rate ends up leveling out, and using the new numbers to put them into this model. But at the same time, I also want to remain cognizant to the fact that Tom Lee has said that there are a couple of different ways to value Ethereum, but one of the best ways that he actually sees is to use the ETH to BTC ratio. And I think I want to incorporate that into the way I look at Ethereum and its valuation. And because I have actually explained in this video that the shareholder yield method does not fully fit how Ethereum actually works. So because of that, I do think it is helpful that at this point in time, we use different valuation methods to try and understand the valuation of Ethereum as well as BMNR and take an aggregate valuation. And with that, back to the video. So putting all of these things together, you can see right now the shareholder yield for Ethereum comes in at around 1.55%. Compare this to Nvidia on the other side. Today, Nvidia is trading at around $182, and at this price point, the Nvidia shareholder comes in at around 0.97%. What Tom Lee is actually saying, or his argument over here, is that if shareholders are willing to accept a 0.97% yield on Nvidia because it is a fast-growing company, then similarly, they should be willing to accept the same level of yield on Ethereum, which is a similarly productive and fast-growing asset. But like I said, all of this really is dependent on the pace of adoption of Ethereum. And based on recent data, of course, we are seeing the build out on the Ethereum network start to happen. Now, with these numbers, you get a 1.55% shareholder yield. And with the price of ETH today coming in at around 3,000, which is the number that we are using, you get an ETH yield per token at $46.58. Now, this combines the dollar value of the ETH being burned as well as the dollar value of the ETH being issued. Now, previously, at this point, with this number, we used a shareholder yield between 0.6 to 0.8% to calculate the valuation of Ethereum, because this was what Nvidia was operating at a couple of years ago when they first issued their dividends. However, after we corrected a slight mistake in the calculation that we had, we realized that an even more conservative estimate would actually also still give us more than decent returns, which actually makes the case for Ethereum even more bullish that I made changes to. And so when I did that video, one of the things that I was slightly uncertain about is saying that ETH will get to the same kind of multiple as Nvidia, because objectively, if you look at the data today, ETH is still less valuable to the world compared to Nvidia as of right now. I know the potential that ETH has is tremendous, but as of right now, the value that it is bringing to society, I would say that Nvidia is still more valuable than Ethereum. So I think for me, it would make sense that because of that, we use a more conservative shareholder yield as our valuation. It's the same thing as Palantir, right? When Palantir was growing at only 12-15%, the multiple was not so high. But now, because they're growing at 50-60% year over year, that's why they deserve the multiple. So in the same way, I do think that, of course, as we see an increased levels of activity on the Ethereum network, a sustained level of activity on the Ethereum network, then perhaps we can lower the shareholder yield. But for right now, I feel more comfortable using this more conservative shareholder yield. Now, if you assume Ethereum just trends back to that 1% shareholder yield, like what Nvidia is trading at today after the correction in the market, then that gets you to an Ethereum price of around $4,657. And if you assume that it goes back to around 0.8, 0.9% shareholder yield where it was previously, where Ethereum was previously, before the liquidation event, then that gets you to an Ethereum price of between $5,175 and $5,800. Now, moving forward, I've already mentioned in some of my previous videos that my assumption is that ETH eventually recovers to around $4,000 per token by the end of Q1 2026. And the assumption over here is that Bitmain will stake their entire ETH position. I think by then they will be close to their 5% numbers. And so if they're staking the entire ETH position through Maven and their three other partners, with a 3% staking yield, that would be an additional 180,750 ETH tokens being issued, making the total amount of ETH tokens being paid to validators coming in at around 1.15 million ETH tokens, or a total value of around $4.6 billion. Now, we have already seen how the ETH burn rate can actually run at an annualized rate of 18 million. But what we are assuming is that it just doubles from the 900,000 that we were talking about earlier to around 1.8 million ETH being burned. Now, that will put the total value of ETH being burned coming in at around $10.48 billion. Now, if you put these two numbers together, you will get a total yield of around $15 billion. And if you calculate the yield per token, this would come in at $125.91. And so from here, the shareholder yield that we are using is actually between 1.6% to 2% yield. And so with a 2% yield, which is fairly conservative, we would expect the market cap of Ethereum to come in at around $758 billion. And with that, you get ETH at around $6,295. Now, using the same calculations, if you use a 1.8% shareholder yield with an increased productivity of ETH should come in at around $6,995, basically close to $7,000. And at a 1.6% yield, Ethereum should be worth around $7,869. And I believe that is how Tom Lee has probably gotten to his number of $7,000 ETH by January of 2026. Now, the difference over here is that I'm expecting this to happen perhaps in the later part of Q1 2026, going into Q2 of 2026. So if you take a look at the valuation with me over here, the same assumptions that I have had previously, the only change is what you're seeing over here, the price of Ethereum. I'm using $6,295 by 31st of March 2026. This is the most conservative number that we have. And then if you aggregate the price of BMNR over the bear, base, and bull case, what you end up with is that you get a BMNR price target by the end of Q1 2026 at $99.91 if Ethereum goes all the way up to $6,000 to $7,000. And with that, I'll see you in the next one.